Good day, everyone. I'm Jacques Conradie, the CEO and one of the fund managers at Peregrine Capital. Thank you for tuning in today. Our presentation today is entitled 100 Times Your Money, and it's linked to our high growth fund that at the end of last year became the first ever South African fund to deliver 100 times return for investors from inception. No other fund has done this. The presentation is not only about that though. We're going to spend most of the time talking about what we do differently, what differentiates us from the typical fund manager, and why we've been able to deliver that returns, while at the same time discussing why we think it's sustainable going forward. So first off, I'll just do a quick introduction. We're a boutique fund manager with a 22-year track record. The business started in 1998. We currently manage about 10 billion rand of investor assets, and we've had a consistent investment process all the way since inception. That means that you can look at our returns all the way through and be comfortable that it was generated using the same investment approach and the same bottom-up stock picking approach. Many of you will know the hedge fund industry, but for those that don't, we are fairly well regarded in the SA hedge fund industry. The Hedge News Africa Awards is the hedge fund industry's version of the Raging Bull Awards in the long-only industry. And at those awards, we've won several of the long-term performance categories over time. They've had a 5-year award for the last 9 years. We won the 5-year award in 6 out of those 9 years. And they've had a 10-year performance award for the last 2 years, and we won it in both of those 2 years. At the top right of the slide, you'll see the 2 achievements that we're probably most proud of in our funds. The 100 times money that I've already touched on for the high growth fund, and that'll be a theme across the presentation. And the fact that our pure hedge fund, which has delivered about close to 65 times money for investors now, has actually never had a negative year in this entire 22-year time that it's been running. All right, so before I get into our process and what we do differently and how we differentiate it versus the peer group, let's quickly look at the results of those processes over just a few slides. So this is the high growth fund. As I said, R1 million inception is worth close to 110 million rand right now. We've plotted it for you with the all-share index and also the multi-asset high equity category, which is the SA Balanced Fund category and the largest unit trust category. You'll see that the high growth fund has delivered almost 10 times outperformance versus those other 2 peer group funds. I think the other point worth noting on the slide that I'll touch on in the next slide is the fact that the high growth fund has not had any significant material pullbacks over this time. It's been a fairly smooth and steady outperformance that has just compounded year in and year out over this past 20 years. So let's look at the risk management framework and the results of our risk management, because it's a key part of what goes with returns. The pure hedge fund, the other flagship fund we've had, has never had a negative year in its entire 22 years. And the peak to trough drawdown that it's ever had was less than 5% at 4.9%. The high growth fund is a fund where we do take some more equity exposure. It's similar risk metrics to a balanced fund. Even there, I think the risk management's been great. We've had 19 out of 21 positive years versus 15 out of 21 positive for the JSE, and the peak to trough drawdown has been 17% versus 40% for the JSE Capped Swix Index. Also, a significantly larger percentage of positive months for both pure hedge and high growth. Finally, I think this slide is a key one that goes with an overall portfolio construction view. The 5 red bars here are the 5 largest unit trust funds in South Africa. What you'll notice is that all of them are very highly correlated with the overall market. So this is over the last year, and you'll see the correlation here is somewhere between 65 and 95% correlation for all these large funds. So while you think you're picking different managers, you're really just piling on the same risk, and many of these managers will perform largely equally in times of severe market stress or periods of good market returns. If you compare that to our funds over the last year, the high growth fund has only had a 25% correlation to the market, and the pure hedge fund has actually had a negative correlation versus the overall market. This means that these funds, over and above the excess returns they generate, will actually dampen and reduce the risk in your overall portfolio. leading to lower volatility and, most importantly, lower drawdowns in periods of stress. Let's now get on to the key principles that has historically made this possible. I want to talk through a few of the key approaches with regards to how we pick stocks, the type of ideas we identify, and also how we manage risk. And each of these we will accompany with a current portfolio example or an historic trade idea to illustrate to you how this gets applied in practice. It's often easier to understand a principle if you can see how it gets executed in a share or in the overall portfolio. So let's first start with one of our current major long positions, Facebook. And the theme of this slide is looking for mispriced optionality. Facebook was acquired at below $120 a share, a little bit less than 5 years ago now in November 2016. We still own the position right now. It's delivered about 3 times return on investment for our investors. It's trading at around $330 right now. But the best part here is that it's still one of our largest positions. Typically, a share that gives you 3 times money is a share you sell and you move on from. However, identifying the right growth opportunities in a company and the right growth share means even if it delivers fantastic returns, if the company's franchise value has grown by an equivalent amount in that time, you can happily continue to hold the position in your portfolio. So you'll see here, Facebook sits at the top, but there's a massive iceberg of value underneath that we think the market at the time of investing in 2016 didn't identify and still doesn't fully price right now. So what do we mean by looking for mispriced optionality? It means finding a share where the core business on its own has attractive prospects and is also attractively valued by the market, but where the market is missing certain exciting opportunities within the business to significantly grow revenue or profits over and above what consensus and what everyone else is forecasting. So back in 2016, the key optionality that was mispriced by the market was Instagram. The whole market saw the marketing revenue from the core Facebook platform and the great ads they show investors or they show users there, but they missed the opportunity and the time spent that was moving to Instagram and the monetization and revenue opportunity from ads there. So that was the key part that they missed over the last 5 years. And as we expected, it played out. Instagram has had a fantastic 5 years with huge growth in users, time spent, and thus revenue for Facebook. However, what we think the market's still missing back then and today is businesses like WhatsApp and Oculus within Facebook. So WhatsApp is probably the most used app on earth. I'm sure almost every single one of you have this installed on your phones. And Facebook currently make virtually no revenue from the WhatsApp platform. We think there's huge opportunity to charge businesses for having WhatsApp profiles and eventually to introduce things like payments, like business shops, and many other features that could turn WhatsApp into a proper platform within your phone. As I said, very, very little revenue coming from this at present. And then the other opportunity further out would be Oculus. So Oculus is the leading virtual reality headset producer in the world, but what they're really going after is the massive VR and AR, so AR being alternative reality opportunity that could happen over the next 5 or 10 years. We had 20 or 25 years where desktops was the main computing platform from probably the mid-80s to the end of the 2000s. And then from about 2008 and 2009 when the iPhone launched, the main computing platform shifted to mobile. We think we're nearing the end of that era, and in the next 5 or 10 years, the next shift might happen. So Facebook is investing aggressively to be a potential winner in that landscape through the investment in Oculus. They've got 10,000 people there. They're probably investing 20% of the overall Facebook profits into this opportunity. If they win, it could double Facebook's valuation in the long run. And even if it doesn't work out, at least you've got expenses that will significantly reduce and drive profits for the overall business. You'll see here I've also got Marketplace listed, which is a great example of further innovation they've brought to the core Facebook platform. This has driven significantly increased time spent on the core Facebook platform, and at the same time it killed alternative businesses like OLX and Gumtree that significantly lost market share in classifieds and Marketplace to Facebook over that time. So amazing execution, a very cheap core business, and lots of optionality for further growth is why this is still a major position for us. Let's now move on to something completely different. Facebook is a nice story to think about. Many of you know the business, many of you know all the apps they use. We also thrive in situations where things are complicated, where it's hard, where it's not so visible, and where you've got to do a ton of work to identify the opportunity. We think we've built a very unique set of expertise in that part of the market. The specific example here is African Bank, but we've probably got 3 or 4 significant holdings over the past 10 years. That was very complicated situations where our team did a lot of detailed work, dug deep, went through hundreds of pages of circulars, of pre-IPO documents, of listing papers, a wide variety of work. We love those situations because we know that most fund managers are not willing to do that work. It takes days for you to go through all this information, to compile your thesis, to go see the company, to reference check everything, and then you don't know if it's an opportunity till the very end when you've been able to build your model. Our team has the hunger and the drive to love doing this because we know it generates alpha that's not correlated with the overall market, but related to how the specific scenario plays out. So what I've listed here is African Bank stub notes, where we've made about a 10 times return for investors after the African Bank failure. African Bank was split into a good bank and a bad bank, where the good loans was moved into the good bank, where clients were repaying, and the bad loans were moved into a bad bank. And we identified the opportunity in the bad bank loans and the bad bank bonds to say these were underpriced, they were doing well collecting on this back book, and there was a real opportunity to make excess returns for our funds. A similar example might have been Steinhoff, where around the failure about 5 years ago now, we dug through all the instruments and found the pref share that was completely mispriced and misvalued by the market. So it shows you being willing to do this detailed work time and time again is likely to lead to consistent alpha opportunities in the long run. Let's now move on to mistakes. One of the key behavioral things as an asset manager is realizing that you will not always be right when making a call. When trying to find the right share to invest in, inevitably you are trying to forecast that business and how it will perform over the next 3 to 5 years. Dealing with the future is inherently uncertain. It's just not possible to predict all possible events that could happen, and also new information could emerge that you didn't have access to at the time. So as a team and as a business, we are very open-minded about the fact that we will get investment calls wrong. There's nothing wrong with it. There's just no other way you can invest and not get some calls wrong. In fact, it's fairly normal for us to potentially get 2 or 3 out of 10 of our calls wrong. The key differentiator is, though, being open-minded about this and thus dealing with those mistakes quickly. As soon as it emerges that we might have gotten something wrong, dealing with it and cutting the position before it becomes a big loss. And I think this has been a highly important differentiator for us. At many larger asset managers, you might find people embarrassed to admit mistakes because it means they have to admit they're wrong and it maybe impacts their career at the business. Our culture allows everyone in the team to be extremely open and actually to embrace mistakes as learning opportunities and opportunities to correct positions in the portfolio. So one example I'm going to touch on here is Fortress B shares. And I mean, this was a painful loss for us at the time. So we had held the share for many years and kind of got substantial returns from it over time in the SA property bull market from, let's say, 2009 to 2017. However, Fortress B shares is a leveraged play on the SA property sector. And in January 2018, new information emerged about governance at the company, about their accounting methodologies and how aggressively they might have been paying out distributions that led to us reviewing our investment thesis on Fortress. The share had started moving against us, and when something is down 10% from where we entered or from the previous high, we will do a stop loss process at that stage. What the stop loss entails is the primary analyst or fund manager presents the position to the team, but at that stage, the whole team gets to debate it, and the fund managers that are not the primary ones on the share get to make the call. In this example of Fortress, we realized that this was new information that significantly altered our view on the company. As a business and as a team, our view is very clear. When you get new information, you should be willing to change your mind when that information changes the thesis. So we aggressively exited our position, potentially impacting the market as we sold aggressively. We sold out at about a 27, 28 Rand share price, so with a loss off the peak, but significantly saving investors and the fund money. The share was down to kind of 12, 13 Rand, down a further 60% from where we sold only 2 or 3 months later, showing you the discipline of being willing to embrace your losses and acting early to protect the portfolio. Very much linked to this point, to the previous slide, is what you then learn from your mistakes. So be open-minded about them, act aggressively, but then also try to improve and tweak your investment process and portfolio to have a lower chance of those mistakes happening again and impacting the portfolio again. The example I'm going to touch on here is from the global financial crisis in 2008. This is a long time ago now, but as 2007, 2008, and 2008 happened, we saw the global and SA economies deteriorating. However, at the time, we had a significant exposure to SA small and mid-cap shares in the portfolio. So what this meant is, even though we could see the troubles coming, we simply couldn't exit from the shares we had in the fund, even though we saw their kind of outlooks deteriorating. So in the end, we ended 2008 down about 17%, or that was the maximum drawdown in 2008, versus about a 40% drawdown for the capped SWIX. So we still did much better than the market, but we certainly left some money on the table by having too much exposure to small cap and mid cap shares and giving up that flexibility that you have to thus act quickly. It's interesting that it took us about 10 or 12 years for us to really benefit from this adjustment we made to the investment process. Since 2008, we've consistently focused on increased liquidity in our fund and ensuring that we can still aggressively reposition and move the portfolio if things changed. So in 2020, when COVID emerged during Jan and Feb, we were able to identify it, but this time, because our portfolio was liquid enough, we could act aggressively and reposition the portfolio. The result of this is that we end up only down kind of 6% or so as a peak to trough drawdown in the high growth fund versus a 27% drawdown for the market. So we only had about a quarter of the market's drawdown in the 2020 crisis, really benefiting from those learnings that we had kept as part of our investment process for the previous 12 years after going through them in 2008. We try to do this all the time. Whenever we find we've done something wrong or there's an opportunity to do something better, we implement this in our investment process. We've got an error log that we can consistently go through, and it helps you deal with future situations that come up. Let's now move on to another example around PPC, and this one's entitled Investing as a Contact Sport, because it deals with the emotions of owning a share during difficult periods of time. So we bought PPC in about the third quarter last year, identifying it as a recovery play that's linked to the SA economic recovery, and we bought the share at an average price of around 80 cents and sold it recently in the last few months at above 3 Rand a share. So most people would think, geez, that's a nice 250% gain, and that would have been a nice story to hold. However, if you didn't own the share, you won't realize that the share fell almost 50% during the initial 2 or 3 months of us holding it. So that is a real stress test where it's very easy to doubt your investment thesis and to potentially panic at the wrong time. Remember from a few slides ago, we said that we've got a stop loss process that triggers when we lose money on a share. And that process is exactly to identify, did we miss something here? Is it a position we need to exit? Or is this just the market panicking and the market getting it wrong and we should take advantage of that and buy more? So PPC, that was tested to the extreme with a share falling kind of 40-50% within the first 2 or 3 months of us owning it. In this case, David, our chairman, was the primary analyst. He stayed very close to the company. He did a lot of research, kind of site visits, channel checks with with retailers and identified that the business was trading well and very likely to get through the tough times as the SA economy recovered. This gave us the conviction to hold the position and buy more into weakness, and thus to be there for the participation to the upside. It just shows you, I think, very clearly the conviction you need to have in your shares and the ability to differentiate when a company moves against you. Is this just the market getting it wrong and panicking, or is there really something wrong with the business? And knowing when to cut and when to say, we're right here, we're going to buy more, is a key investing skill and a key part of your emotions you've got to manage well as an investor. Finally, looking off the beaten track. Our team has spent a significant amount of their time over the last 5 or 6 years hunting in global markets, finding new sectors and new companies and new countries to invest in. This brings new opportunities to the fund of businesses that we cannot find in SA, new return prospects for investors, and also the ability to generate uncorrelated outperformance for investors. One great example of this is a business called Evolution Gaming, and it's the largest back-end provider of online gambling software to the global online gambling space. So gambling, like most other sectors, are moving steadily from the casino, from real-world activities, into online, being on PC or mobile phones. It's actually taken longer than most kind of sectors to move online because the software initially wasn't good enough. However, Evolution changed all that, and they brought the physical online or the physical gambling experience to mobile devices by having real blackjack dealers, real roulette croupiers that you could interact with on an app. You could speak to them, you could engage with them, and it completely basically changed the game for engagement for users. So their clients, being the online gambling providers, love them because they lead to more spend on the platform, and even the end users love the product. This has resulted in spectacular growth. The business grew more than 100% last year, and so far this year it's also growing above 100%, while at the same time making spectacular margins. Their EBITDA margin was about 65% last year. They've got a unique portfolio of fantastic games. I think they're unmatched in terms of their innovation and their launch of new games. So we think this is a structural long-term growth story. And the beauty here is there really is nothing like it in SA. There's no SA businesses growing sustainably at like 50 to 100% at these kind of margins. While you get businesses bouncing back from COVID, this is a structural growth story that benefits from that continued online penetration that you've seen in many sectors of the economy. So where does all this leave us with regards to portfolio construction? If you look at the shares we own, we think the best place in the market right now is high quality global franchises that's fast growing and that's trading at reasonable and attractive valuations. So what we've done here is we've looked at our top 10 shares in the high growth fund and compared that to the S&P 500 and the SA Financials and Industrials Index. You'll see here that the ROE within high growth is about 30% versus only about 10 to 15 for the S&P 500. ROE is a major driver of long-term outperformance. Next, you'll see that gross margin and operating margin, representing the profitability of the businesses, is also substantially higher. I mean, our portfolio is a 33% operating margin versus 12 or 13% for the S&P and the Financials and Industrials Index, giving you a significantly larger buffer of profits in case the economic cycle turns or to absorb potential inflation that we're seeing right now. And finally, and most importantly, the biggest driver of future performance of these shares will be the growth in their franchise values and their earnings. And you'll see here, over the 2022 and 2023 years, which is effectively post-COVID, our portfolio is expected to grow close to 30% versus low teens for the S&P and about 20% for the Financials and Industrials Index. And that 20% is less structural growth and more just of a COVID bounce back that we're still seeing in SA. We remain highly worried about the medium-term prospects for growth in the SA environment. All right, let me spend a few more slides on our individual funds and the risk reward you can expect from them before then concluding. If you look at the two flagship funds that we've discussed here today, the Pure Hedge and the High Growth funds, what we've done here is on a 15-year basis, compared the returns and risks of these two funds with the major market categories that most of you would be using. So Pure Hedge looks very similar to the stable fund category. It's actually got slightly lower vol than the typical stable fund, yet it's outperformed by about 5% per annum over that 15-year time horizon. The high growth fund looks quite similar to the typical balanced fund in terms of equity exposure, in terms of volatility, yet it's outperformed by about 10% per annum over the last 15 years. And it's even outperformed equity funds at much lower risk by about 8% per annum over that 15-year time horizon. So this gives you a framework about where to place our funds in terms of the risk-reward spectrum versus the unit trust you'd currently be using in client portfolios. On this slide, what we did is we said, let's compare our two funds versus the entire unit trust category. Most players will just compare their funds to the overall market or to the mean of the category or the median fund in a certain category. What we've said is, let's go back to the inception of our funds and assume an investor could pick the very best fund out of that entire unit trust industry. So not just a specific sector, let's assume out of the entire 2,000 unit trusts, an investor had perfect foresight and could pick the very best fund. If you compare that to our funds, I think the picture is quite pleasing. The high growth fund has done 10,900% return since inception, versus the next best fund, still a very pleasing 3,400%. But it means we've done more than 3 times better than the very best fund in SA that's not our fund. Additionally, the Pure Hedge fund has done 6,400%, about double what the next best fund in SA did, at substantially lower volatility, while never having a negative year and never having more than a 5% drawdown in that time frame. So who's the high growth fund appropriate for? We think it's appropriate for any investors that's looking to substantially grow their wealth over a long period of time, while having some degree of risk appetite, similar to investors in a typical SA balance fund and maybe even an equity fund. So it's really got moderate levels of risk, and what we try to do is focus on our very best ideas and help investors compound their wealth. Most of the fund managers have the vast majority of their liquid net worth invested alongside investors in our high growth fund, where we're with investors there and we're there for the long run. If we break down returns over various time periods, I think the pleasing thing on this graph is that over 1, 3, 5, 10, 15, and since inception, we've outperformed on every single time period versus the multi-asset high equity category. And the outperformance has actually been fairly consistent at about 5 to 10% per annum. I think the 10, 15-year numbers, between 15 and 20%, is really what we aim for in this fund. And I think the way the portfolio is positioned right now, we'd hope that over the next 3 or 5 years, we can continue to deliver that kind of outperformance for investors while managing downside risk. If we now move on to the Pure Hedge fund, this is a really low risk product with very, very stable returns over time. The one thing you'll pick up from this blue graph is after the significant outperformance versus inflation and versus the stable fund category, you'll see just how stable it's been, with very, very little in the way of drawdowns or material losses for investors at any point in time. So the ideal investor here is someone that wants to beat inflation but doesn't have massive risk appetite or appetite for drawdowns. If we look at the various time periods here, I think the picture is again very, very pleasing. Pure Hedge has outperformed the stable fund category over all of these time periods, and additionally, it's delivered a very, very stable kind of 10 to 12% return per annum over all the shorter term time periods, 1, 3, 5, 10, and 15 years. Very consistent in that low double-digit kind of range. That's really what we aim for, giving investors a nice 5 or 7% above inflation on an annualized basis. So as a final slide, what we've tried to do is effectively summarize what we try to do in our products by showing you what it will do if you add this to a portfolio of funds. So we've started with a typical 60% equity, 40% bond mix and said, what has that given an investor? Over the past 10 years, it's given you about 7.5% per annum performance with a peak to trough drawdown of 23% and about 11% vol. If you instead, rather than running that, if you added 10% of our high growth fund and 10% of our pure hedge fund, so just a 20% mix in hedge funds, you significantly upped your return. You upped your return from 7.6 to 9.7%, more than a 20% increase in your actual return for the period. You've substantially reduced your peak to trough drawdown from 23 to a close to 16%, and you've also taken about a quarter of your volatility from 11.4 to 8.6. So even with a small allocation to our funds, it materially alters the expected return from a client's portfolio over time. Obviously, if you look at a 20% and 20% inclusion of our two funds, the picture looks even better with an 11.5% expected return, again with a further reduced drawdown and standard deviation. Now 2 or 3 or 4% per annum maybe doesn't seem material, but on the right there you'll see over a 10-year time period, by only making the small allocation to hedge funds, rather than having 2 million rand at the end, and a client could have had 2.5 or 3 million at the end. And remember, this is while taking lower downside risk and having lower drawdowns. So in the end, this just leads to much more happy investors. They don't have to panic as much during market drawdowns, and they end up with a greater portfolio value at the end of the day. So thank you very much for listening all the way through. We've got our website listed there. If you want to chat with us, please reach out on the website or email us. We're very happy to provide more information. And we also want to thank many of you that has interacted with us over the last 12 or 18 months. It's been very, very pleasing seeing the level of interest in the IFA community and hedge funds. Now the products are more freely available on all the major platforms. And I think from what we've seen over the last 12 or 18 months, it's clear that this will probably be a substantially bigger part of the market over the next 3 or 5 years, given the return enhancement and risk reduction it can bring to clients. So please reach out and chat. We're very happy to provide you with more information. Thank you very much.